Capital Logic. Today's case study: how Netflix killed Blockbuster, then almost killed itself. We're going to show you exactly how this business model works, where the money actually comes from, and what most analysts miss. Like and subscribe if you want this kind of breakdown every week. Here is what you need to know. Netflix, the company that drove Blockbuster into bankruptcy with its innovative model, nearly suffered the same fate years later by attempting to split its own business. It's a story of incredible vision, but also a stark reminder that even industry giants can stumble spectacularly. Stay until the end. I'll break down 3 lessons from Netflix's playbook you can apply to your business this week. If you want business breakdowns you can actually use, hit subscribe and the bell. In the late 1990s, if you wanted to watch a movie at home, you drove to Blockbuster. It was the undisputed king, a retail behemoth that defined an era of entertainment. At its peak in 2004, Blockbuster generated an astounding $5.9 billion in revenue and operated over 9,000 stores worldwide. Think about that for a second. 9,000 physical locations, each one a temple to the VHS tape, and later the DVD. Their business model was simple, effective, and deeply ingrained in American culture. Rent a movie, return it, pay a late fee if you were tardy. And those late fees? They weren't just an annoyance, they were a significant revenue stream, a hidden tax on forgetfulness that Blockbuster was more than happy to collect. But while Blockbuster was basking in its analog glory, a tiny, unassuming startup was quietly mailing DVDs in red envelopes. Netflix launched its DVD by mail service in 1998 with a radically different idea, a subscription model. For $15.95 per month, you could rent as many movies as you wanted with no due dates and, crucially, no late fees. It was a direct assault on Blockbuster's most profitable, yet most hated, policy. Netflix wasn't just offering convenience, it was offering freedom from the nagging anxiety of returning a movie on time. The difference in scale between these two companies at the turn of the millennium was almost comical. Netflix was a niche player, an internet curiosity. Blockbuster was everywhere. And yet in 2000, Netflix CEO Reed Hastings did something audacious. He flew to Blockbuster's headquarters in Dallas and offered to sell 49% of Netflix to them for just $50 million. Partnership: Blockbuster would promote Netflix's online service, and Netflix would handle the burgeoning digital side. The story goes that Blockbuster CEO John Antioco, along with his executive team, reportedly laughed them out of the office. $50 million for a company that was, at the time, still figuring itself out? It seemed absurd. But that laughter, as history would prove, would echo with the sound of a missed opportunity so monumental it's still analyzed in business schools today. Blockbuster saw a tiny competitor. Netflix saw a future. Fast forward a few years. Blockbuster, perhaps feeling the first tremors of disruption, finally launched its own D2V.D by mail service, Blockbuster Total Access, in 2004. It was a clever move, allowing online subscribers to return DVDs to physical stores for free in-store rentals. For a brief period, it even worked. Total Access acquired 2 million subscribers within 6 months in 2005, forcing Netflix to cut its own prices and increase marketing spend just to keep pace. Blockbuster CEO John Antioco invested heavily, reportedly $400 million, into this hybrid model. But it was too little, too late, and ultimately a misdirection. The activist investor Carl Icahn famously opposed these investments, seeing them as a drain on Blockbuster's core business. He was right. Blockbuster reported a net loss of $1.1 billion in 2006, signaling deep financial distress. Meanwhile, Netflix was already looking past the mailbox. In 2007, they made their truly visionary move, introducing a streaming service. Think about that timing. High-speed internet was becoming more common, but the idea of streaming a full-length movie was still nascent. Netflix didn't launch it as a standalone product. Instead, it was a free add-on for existing DVD subscribers, requiring at least an $8.99 per month DVD plan for access. This was a crucial strategic pivot, a way to gently introduce their existing 7.5 million DVD subscribers to a new technology without alienating them. They understood that the future wasn't just about how you got the movie, but the instant gratification of Blockbuster, still clinging to its physical stores and struggling with its belated DVD by mail effort, simply couldn't adapt. The infrastructure, the leases, the sheer inertia of 9,000 stores, it was an anchor. While Netflix's subscriber count reached 9.4 million by 2008, Blockbuster's digital efforts lagged. The writing was on the wall, etched not in neon signs, but in broadband cables. On September 23, 2010, Blockbuster filed for Chapter 11 bankruptcy protection, burdened by $929.7 million in debt. The king was dead, brought down not by a direct frontal assault, but by an agile disruptor who saw the future and built it, piece by piece, while the incumbent was still counting its late fees. Netflix's revenue, meanwhile, soared from $1.36 billion in 2007 to $2.16 billion in 2010, almost entirely driven by its burgeoning streaming segment. Netflix had won the market war. They had slain the Goliath. They were the undisputed champions of home entertainment, poised for global domination. But then, something extraordinary happened. In 2011, at the absolute zenith of their power, Netflix made a series of decisions that nearly brought the entire company to its knees. It was a classic case of hubris, a moment where the very confidence that had fueled their success became their greatest liability. In July 2011, Netflix announced a massive price hike. Previously, customers could get both DVD and streaming services for a combined $9.99 per month. Netflix decided to split these into two separate plans, each costing $7.99 per month. For customers who wanted both, the price effectively jumped to $15.98, a staggering 60% increase overnight. The reaction was immediate and visceral. Customers felt betrayed. Netflix celebrated its disruption and now felt like they were being punished for their loyalty. The company, which had built its brand on customer-centric innovation and value, suddenly seemed tone-deaf. The fallout was swift and brutal. In Q3 2011, Netflix lost 800,000 subscribers, dropping from 24.6 million to 23.8 million. This wasn't just a dip, it was a significant and unexpected reversal for a company that had known nothing but exponential growth. But the worst was yet to come. In September 2011, Reed Hastings, in an attempt to mollify angry customers and streamline operations, announced another bewildering decision. He would separate the DVD by mail service into an entirely new company called Qwikster. Qwikster would have its own website, its own branding, and separate billing. It was a logistical nightmare for customers who wanted both services, forcing them to manage two accounts, two bills, and two queues. The public outcry intensified. The internet exploded with ridicule and anger. The Qwikster announcement was retracted just 23 days later. On October 10, 2011, a humiliating climb down for a company that had seemed invincible. The financial markets reacted with equal ferocity. Netflix's stock, NFLX, plummeted by over 75% between July and November 2011, from a high of $42.50 to below $10. In a matter of months, Netflix's market capitalization dropped by approximately $11 billion. The company that had so brilliantly outmaneuvered Blockbuster had, through a series of baffling decisions and colossal miscommunication, almost killed itself. The question became, could Netflix recover from such a spectacular self-inflicted wound, or was this the beginning of the end for the streaming pioneer? The Qwikster debacle wasn't just a misstep, it was a near-fatal blow. Netflix's market capitalization dropped by approximately $11 billion in the months following the Qwikster announcement and its swift retraction. Its stock, NFLX, plummeted by over 75% between July and November 2011. The company had lost 800,000 subscribers in Q3 2011 alone, dropping from 24.6 million to 23.8 million. For a company that had consistently defied gravity, this was a brutal, humbling fall. But here's where the story takes another turn to a testament to strategic audacity born from the ashes of failure. Reed Hastings and his team understood something fundamental. The future of entertainment wasn't just about delivery, it was about ownership. They needed to control the content, not just license it. Licensing meant being at the mercy of studios who could pull their shows at any moment or demand exorbitant fees. It meant competing on price and convenience, a race to the bottom. So, in the wake of their greatest public relations disaster, Netflix made a decision that would redefine its entire business model. They decided to become a studio. This was a massive gamble. Netflix had no experience producing television shows, but they had data to mountains of it. They knew what their subscribers watched, what genres they preferred, which actors resonated, even which directors had a loyal following. They could see patterns in viewing habits that no traditional network could. And they used this data to make an audacious bet, a political drama called House of Cards.
In February 2013, Netflix launched its first original series, House of Cards, investing an unprecedented $100 million for 2 seasons upfront. Think about that, $100 million for a show that had never aired a single episode, on a platform that was still primarily known for mailing DVDs. Traditional television networks would greenlight a pilot, test it, then maybe order a few episodes. Netflix ordered 2 full seasons, sight unseen, and then dropped all episodes of the first season simultaneously. This was revolutionary. It birthed the binge-watching phenomenon, a new consumer behavior that would forever change how we consume television. The bet paid off. House of Cards was a critical and commercial success, garnering Emmy Awards and, more importantly, attracting millions of new subscribers. By the end of 2013, Netflix reported 44.4 million global streaming subscribers, a strong rebound from the 2011 crisis. This wasn't just a recovery, it was a transformation. Netflix had proven that it could create compelling, high-quality content that people would pay for. It wasn't just a distributor anymore, it was a destination. This pivot wasn't cheap, though. The content budget exploded. From $2.4 billion in 2013, it soared to an estimated $17 billion in 2020. This wasn't just about House of Cards anymore, it was about building an entire library of original films, series, documentaries, and stand-up specials. Netflix became a content arms race participant, and then, arguably, its leader. This aggressive investment in original content fueled Netflix's next major strategic move, global domination. In 2016, Netflix expanded its service to 130 new countries simultaneously, achieving near-global coverage in one fell swoop. This was an incredible logistical and content licensing feat. To do this, they needed content that transcended cultural boundaries, or, even better, content produced within those boundaries. And with their massive content budget, they could afford to do both. The results were staggering. By Q4 2020, Netflix reported 203.7 million paid subscribers worldwide. Their annual revenue reached $25 billion in 2020. They had not only recovered from their near-death experience but had emerged as an undisputed global entertainment powerhouse. But success breeds competition. The very model Netflix pioneered to subscription-based streaming with high-quality original content became the blueprint for others. Disney Plus, launched in November 2019, quickly amassed over 100 million subscribers by March 2021, showcasing the intense new battleground. Amazon Prime Video, HBO Max, Apple TV+, Peacock to the streaming wars were in full swing, and every major media company wanted a piece of the pie. Netflix, once the disruptor, was now the incumbent, fighting to maintain its lead. In 2022, Netflix made another significant pricing strategy shift, introducing an ad-supported tier at $6.99 per month in select markets. This was a direct response to increasing competition and a desire to attract budget-conscious consumers, a move that would have been unthinkable just a few years prior for a company built on an ad-free experience. The company continued to evolve. In January 2023, Reed Hastings, the visionary who had steered Netflix through its many transformations, stepped down as co-CEO, transitioning to executive chairman. And in a final, poignant nod to its origins, Netflix's DVD by mail service, the very foundation of its empire, officially ended on September 29, 2023, after 25 years in operation. The red envelope, once an icon of disruption, was now a relic. Today, Netflix's global market share for streaming subscriptions was estimated at 20.5% in Q for 2022, still leading, but facing relentless pressure. Its operating margin was 18.9% in 2022, reflecting the high costs of content and global expansion. Yet, despite the fierce competition, Netflix projected its free cash flow to be at least $5 billion in 2024, indicating strong financial health and profitability after years of heavy investment. The company that once almost killed itself had not only survived but thrived, demonstrating an extraordinary capacity for reinvention. But what can we learn from this incredible journey? Now here are 3 lessons from Netflix's playbook you can apply to your own business. Lesson 1: Embrace change, even if it hurts. Continuously evaluate market shifts and be willing to pivot your core business model, even if it means cannibalizing current revenue streams. Netflix didn't hesitate to move from DVDs to streaming, even though physical media was still a cash cow. They understood that staying comfortable often means becoming obsolete. Lesson 2: Customer experience is paramount. Identify and eliminate customer pain points, offering superior convenience and value that competitors cannot match. Their early focus on no late fees and a vast, on-demand library directly addressed Blockbuster's biggest weaknesses, creating an undeniable advantage. They understood that friction is the enemy of loyalty. Lesson 3: Learn from mistakes, recover fast. When a strategy fails, admit the error quickly, reverse course, and communicate transparently to rebuild trust with customers and stakeholders. Remember Qwikster? A disastrous misstep, but they scrapped it fast, absorbed the criticism, and doubled down on streaming, proving that agility can save you from even your worst ideas. If you want more business breakdowns you can actually use, subscribe. I'll see you in the next one. That is Capital Logic's breakdown of how Netflix killed Blockbuster, then almost killed itself. Every business has a hidden architecture. We find it, we explain it, and we show you what it means. Subscribe and hit the bell so you never miss a case study. We will be back with another one shortly.